Good afternoon, everyone. Welcome. My name is Josh Stripmatter, and I'd like to welcome you to Stripmatter Wealth Smart Money webinar series. Thank you for joining us today. Our presentation today is titled Summary of Tax Provisions for 22 and 23, and will be presented by Brenda Young at Stovall, Grandey, Allen, or SGA as they're known. For those of you that don't know us, we are Stripmatter Wealth Management Group, a registered investment advisor located in downtown Fort Worth, Texas. We specialize in investment management, financial planning, estate planning, and real estate investing. We've been in business since 2007 and serve clients throughout the United States. A little bit of housekeeping before we get started. All of you have access to the chat feature. So if you have any questions, please don't hesitate to type those in and we'll be happy to answer those for you. Also, we'll be sending out a replay of today's webinar via email. So if you missed something, don't panic. You'll have the ability to watch this again. And also it will be posted to our website. And you are welcome to forward these presentations and any of our presentations to your friends and family if you think it would be beneficial. Today's webinar is meant to be purely educational and not meant as tax or legal advice. Please talk to your licensed professional before taking action on any of the information in this presentation. For more information, including key disclosures, please visit our website at stripmatterwealth.com. Now let me introduce our speaker for today. Brenda Young joined SGA in 1999 and became partner in 2005. Brenda supports SGA's practice with extensive experience providing audit services to financial institutions and tax services to clients in a variety of industries. She lives about 70 miles from SGA's Fort Worth office, but is often the first one in there in the morning. She's completed college after marriage and children and thus exemplifies dedication and determination in everything she does. Brenda loves reading and is an avid sports fan. She's married and has 2 sons. So without further ado, let me hand it off to Brenda. Brenda, good morning. How are you?
I'm good.
Thank you for joining us yet again. We are excited about today's presentation because I'm interested to see what we've got going on in 2023 for taxes this year.
Well, I guess, Josh, one of the things with this is that you're going to find out maybe what you should have known in 22, but hopefully we'll get you prepared for 23.
Awesome.
Okay, so just for those of you, the agenda, we're going to talk a little bit about SGA, cover some key amounts and thresholds for 22 and 23, business loss limitations, itemized deductions, business expenses, some capital gain considerations, and other items. For those of you that don't know about SGA, we were founded in 1972 by David Stovall and Wendell Grandey. Mr. Grandey retired at the end of 2017. Carol Allen joined the firm in 1983 and became a partner in 1995. And as Josh said, I joined the firm in 1999 and became a partner in 2005. Mr. Stovall is semi-retired, and Carol and myself manage the firm. Earlier in November of 22, we actually moved our offices to 4055 International Plaza, Suite 510 in Fort Worth. And David's wife called to thank us for making sure that he had an office at the new location. She said that she told him she married him for life, but not lunch. So the firm's motto is, it's more than just numbers. It's year-round relationships. We strive to become that firm that we build relationships over the years. We realize that the first year that you start working with a client, sometimes there's additional cost. We usually try to absorb those costs because we're looking to make a long-term relationship. We're a full-service CPA firm that provides tax and audit work to a multitude of clients, including financial institutions, employee benefit plans, commercial entities, and individuals. And I've included our website in case you want additional information. So let's get started on the key amounts and thresholds. So the standard deduction, the married filing jointly is $25,900 for 2022. This is going to increase to $27,700 in 2023. The single deduction, standard deduction for 22 is $12,950, and it's set to increase to $13,850 for 2023. Head of household is going to be $19,400 for 22, and that's set to increase to $20,800 in 23. Married filing separately is has the same as the single, where it's going to be $12,950 for 2022 and $13,850 for 2023. So on the IRA contribution limits for 2022, those limits, if you were under the age of 50, was $6,000. If you were 50 or over, that was $7,000. These limits are set to increase by $500 for 2023. The simple IRA plan limits for 22 under the age of 50 were $14,000, for 50 or over $17,000. These amounts are actually increasing by $1,500 for 2023. So you can see that's a little more of an increase than what just the typical IRA contribution limits are. For 401k, 403b, and 457 plans, under the age of 50, it was $20,500 for 2022. For 50 and over, $27,000. These amounts are set to increase $2,000 for those under 50 for 2023 and $3,000 for those that are 50 or over for 2023. The profit sharing SEP limits, the contribution limit for 2022 was $61,000. And that was the compensation limit that could be based on was $305,000. For 2023, the contribution limit is set to increase to $66,000, with the eligible compensation limit set to increase to $330,000. As we all know, there is a limit that you have to pay Social Security tax on wages. For 2022, that was $147,000. For 2023, it's got quite a bit more of an increase. That's going up to $160,200. Required minimum distributions that from retirement plans. Those that are 70 and a half, if age 70 and a half was attained before January 1st of 2020, 72, if age 70 and a half was obtained after 12/31/19, but prior to January 1st of 2023. It's 73 if age 70 and a half was reached after 12/31/19 and age 72 was reached after 12/31/22. And then the Secure 2.0 Act has a provision that this age will increase to 75 beginning on January 1st, 2033. So you don't think this is confusing. You almost have to get a calendar out and look and decide if you haven't started doing those required minimum distributions to even determine when you're eligible or when you're required to. And you certainly don't want to miss those because it's a pretty hefty penalty if you don't take the required minimum distributions out of your retirement accounts as outlined in these age restrictions. And one thing to remember is there's nothing to say that you have to take the required minimum distribution out of each one of your retirement accounts if you have multiple ones, but you do have to take the balance in all of them into consideration to make sure that you take the correct required minimum distribution. But if you have one account that maybe is not earning as much as others, you certainly can take 100% of your required minimum distributions out of that one account. The excess business law provisions were reinstated in 2021 after there was a temporary suspension under the CARES Act due to the pandemic. This provision limits the amount of trade or business deductions that can be used to offset non-business income. The limitation for 2022 is $540,000 for joint filers and $270,000 for all other filers. These amounts are set to increase to $578,000 and $289,000 for 2023. The net business losses in excess of these amounts that are disallowed for 2022 can be carried over forward to future years. And this provision was initially but part of the Tax Jobs and Cuts Act that was passed in December of 2017. And this basically takes into consideration if someone has multiple business interests, it's the combined total of those business losses. For instance, if you a married, say a joint filer, if they have one business that flows through to them either on a K-1 or a Schedule C business, and it has a loss of $500,000, and then they have a second business that flows through on a K-1 that generates losses of $50,000, then combined that's a $550,000 loss, but they would be limited on their 2022 tax return to only get excuse me, a benefit of $540,000. So it's just something to keep in mind. Itemized deductions, which there were some that expired in 2021. The deduction for mortgage insurance premiums expired 12/31/21, so it can no longer be claimed as an itemized deduction in 2022. Another thing that expired 12/31/21 was the deduction for non-itemizers, where they could get a small deduction for charitable contributions. For married filers, they were able to take off as much as $600, and for other filers, $300. But beginning with their 2022 tax return, unless they have enough to itemize deductions, they will no longer be able to do this above the line type deduction. One thing, as this a tax planning opportunity, is to do what they call bunch your itemized deductions, so that maybe you itemize one year and then you take the standard deduction the following year. For example, let's assume that there's a married couple that typically makes charitable contributions of $30,000 annually. And they also have real estate taxes of $12,000 annually. So basically, this would provide them a total itemized deduction of $40,000 each year, because remember, the state and local taxes, which are typically referred to as the SALT taxes, are limited to only $10,000 for a married couple on their return. If they had potentially prepaid the $30,000 contributions that they had earmarked for 2023, if they had paid those in December of 2022, then basically that would give them $70,000 of itemized deductions for 2022. Because remember, that's the $30,000 for 22 plus the prepayment of 23 contributions, and then the limitation of the $10,000 for their real estate taxes. Then in 2023, they could take the standard deduction, which is set to be $27,700. This basically would provide them total deductions when you combine 2022 and 2023 of $97,700 as compared to total deductions of $80,000 if they hadn't bunched and they had just taken the $40,000 of itemized deductions in 22 and 23. So by bunching these charitable contributions, they basically have a reduction in net taxable income of $17,700 when you take the 2 years into consideration in the aggregate. One thing I would say is if you did decide that you wanted to had the ability and wanted to do this, I would make sure that you told the charitable organization so that they were aware that you were actually prepaying the next year, especially if it's one that you've historically supported, because I could see where, you know, the organization could potentially think that they had kind of gotten something over and above when you did that contribution in December and wouldn't necessarily know that they're not going to get the monthly or, you know, contributions like you had previously made. So I think it would be a good idea to let them know, just so it doesn't catch them off guard. So on business expenses, you probably remember that one of the things that happened with some of the pandemic legislation is they did make for 21 and 22, they made meals and beverages that were purchased from restaurants for business purposes. They made those where they were 100% deductible. This reverts back to for 2023 back to the 50% deductibility. There's no change on business meals and beverages that were purchased from non-restaurants. Those are going to be 50% deductible both in 22 and 23. One change that did occur that you need to be aware of for 23 is for the last several years, we've had the 100% bonus depreciation for eligible property. And that basically was property with a tax life of 20 years or below. That expired on 12/31/22. So for 2023, this 100% is going to be reduced to 80%, and then it will continue to have annual reductions in that percentage until it's fully phased out as of 12/31/26. It doesn't really change the overall deductibility during the life of this asset. It just changes the timing. For instance, I had a call from a client and they were like, oh gosh, I didn't realize that expired 12/31/22. And I said, well, don't worry. If you acquire the asset in 23, you're still going to get to deduct that additional 20%. It's just going to be spread over the life of that. You're not going to get the immediate deduction in 2023 for that 20% of the value. So, you know, that's just something to keep in mind. The standard mileage rate for the first 6 months of 2022 is 58.5 cents. For the last 6 months, they increased it to 62.5 cents. They don't do this real often, but they have done it a few times in the future. So just remember, when it comes time for your tax preparation, you need to make sure that you let your tax preparer know this was my business mileage prior to July the 1st of 22, and this is my mileage from July the 1st to December 31st, 22. The standard mileage rate increased to 65.5 cents for 2023. So some capital gain considerations, the long-term capital gains, which are those that are held more than 12 months, depending on your income level, those capital gains can be subject to no tax, 15% tax, or 20% tax rates. The 0% applies to those gains for single filers or married filing separate filers who have income of $41,675 or below. Head of household filers who have income of $55,800 or below, and joint filers who have income of $83,350 or below. The 15% tax rate applies to those gains for single filers who have income of $41,676 up to $459,750. The married filing separately who have income of the $41,676 up to $258,600. Head of household is income of $55,801 up to $488,500. And joint filers who have income of $83,551 up to $517,200. You'll notice in the 0%, the same tax income threshold was for married filing separately and single filers, but in the 15%, they did break those up, and single filers go up to a much higher dollar amount than the married filing separate filers do. The 20% tax rate applies to gains for all filers that basically have income levels that exceed the 15% limits. Now, one thing I wanted to point out is this can be a little misleading depending on what your income levels are, because we can't forget about the 3.8% net investment income tax that is applied to basically unearned income, which includes capital gains, interest income, dividend income, and so forth. That comes into play for joint filers that have modified adjusted gross income greater than $250,000, married filing separate filers with modified adjusted gross income greater than $125,000, and all other filers with modified adjusted gross income greater than $200,000. The net investment income tax is one of those that was part of the Affordable Care Act. So it's been around a while. And so really, in reality, you take like a larger income joint filers, especially that, you know, if they have capital gains that are going to fall into that 20%, in reality, it really is 23.8% in most cases. So proper planning can help eliminate or lower the tax burden that's associated with capital gains. For example, if you have large capital gains, you should consider selling other capital assets that have capital losses, especially if those assets aren't expected to recover your cost. I know I've had some clients before that, you know, have had some stocks, say that, you know, might have gone through bankruptcy. And in that they ended up having like reverse stock splits. So maybe they had 15,000 shares at one point in time that, you know, was worth $80,000. And now they've got 15 shares that maybe are only worth $1,000. You know, that's the more than likely a scenario like that. Those particular assets are never going to recover what your actual cost basis is in them. And so they would certainly be something that you would want to look at maybe just going ahead and selling them so you could take that loss to offset some of the capital gains that you have. Another planning opportunity is to make sure that if at all possible, the capital assets are held for greater than 12 months so that they do qualify for the lower long-term capital gain rates. Because remember, the short-term capital gain rates are taxed as ordinary income. So depending on what your income level is, that could be a pretty significant change in the tax rate relating to them. Another thing that I just wanted to make sure that everyone is aware of is, we've had this around for a number of years, that there is an exclusion for the sale of your personal residence. Basically, if you have lived in a home as your personal residence 2 out of the last 5 years, and you meet the ownership and the use test, a married filing joint filers can exclude recognition of a gain up to $500,000. All other filers up to $250,000. That basically you wouldn't have to pick that up as capital gains. So that's just one thing to make sure you keep in mind, because I know I still get questions periodically from taxpayers, and they're like, okay, I think I'm going to sell my house, and do I need to do a 1031 exchange, that sort of thing. And it's like, as long as you meet that ownership and use test and your gains not over those thresholds, then you really don't have anything to worry about. So some other items that I just wanted to bring to your attention is with the Republicans in control of the House and the Democrats in control of the Senate and the White House, no one is really anticipating that there will be a lot of major changes in tax legislation for 2023 and even 2024. I'm not saying there may not be some, but I don't think anybody is really anticipating there being major changes. Right now, there are numerous tax provisions that are basically set to expire in 2025. Some of these are, there can be some pretty drastic effects from a wealth preservation standpoint if these provisions expire and you didn't take advantage of them. So the annual gift tax exclusion is $17,000 for 2023. This is an increase from the $16,000 in 2022. And this limit applies to a single person. So basically, if you're a married couple, both you and your spouse could gift the same person $17,000, which would be a total of $34,000, without you having to file a gift tax return unless you have other gifts that would warrant that. The lifetime estate and gift tax exemptions is $12.92 million for 2023. This is an increase from $12.06 million for 2022. This is set to reduce to the pre-Tax Jobs and Cuts Act levels as of 1/1/26, which right now I believe that's estimated to be approximately $6 million. So you can see that's a pretty significant reduction. And so, these are individual limits. So for a married couple, the way the limits are right now, they could really, their combined total is $25.84 million for 2023. And so, it would probably take some work in making sure that you're doing everything the right way. But, if your estates are up over these limits, I think that it certainly is something that you should take into consideration if there's a way possible for you to be able to take advantage of these exemption limits while they're this high. Because I don't know, at this point, nobody really knows what's going to happen, but it would not surprise me at all for them to basically decrease back to that $6 million level at the end of 25. So I've got some other things ready for us to talk about that I didn't get on the slides, and I apologize for that, but I wasn't sure exactly how long things would take. And so I wanted to make sure that I had enough information for the time allotted. So one thing I wanted you to discuss a little bit is about Roth conversions. So a Roth conversion is basically a transfer from an eligible retirement account, which would include like your traditional IRA account, simple IRA accounts, and so forth. And so the funds can be received by the taxpayer and rolled basically into the Roth IRA within 60 days, or they can be transferred trustee to trustee. If the conversion is from a traditional IRA to a Roth IRA with the same trustee, the account owner can usually just direct the trustee to transfer the funds. Or if the entire account is being converted, they can usually just redesignate the traditional IRA to a Roth IRA. And so the conversion rules, basically you have the amount of the distribution that would have been included in income if it had not been converted to a Roth IRA, is included in income in the year of the conversion. So any part of the conversion that's attributable to basis is not included in income. For example, if you had a traditional IRA account that had a balance of 100,000, but you really 10,000 of it was your cost basis in it, and you converted that over to a Roth IRA, you would have to pick up the $90,000 in income in the year of the conversion. The 10% penalty tax on distributions before age 59 and a half do not apply to these. The converted amount is treated the same as a regular Roth IRA contribution once you've met the 5-year holding period rule. And then basically, the converted amount could then be withdrawn tax and penalty free, regardless of the taxpayer's age, once you've met that 5-year rule. A simple IRA will qualify also for a conversion, but only if a 2-year period has elapsed since the taxpayer first participated in any simple IRA of an employer. Taxpayers 72 or older can't avoid their required minimum distribution for the year by converting to an eligible, converting an eligible retirement plan to a Roth. For example, if someone 72 or older had a traditional IRA account and they wanted to convert that to a Roth IRA, they still have to make sure that they take their required minimum distribution. I think it's something to consider if you haven't, looked at it, because basically once you convert to the Roth IRA, the earnings are not taxable if you're over the 59 and a half and you've held it for the 5-year period. So, I've heard some, depending on what you have your retirement money in, I think we all know that the market has been down, the last year. And so if you've thought about this in the past, now might really be a time to consider, because the value's down, which would then decrease the amount of income that you would have to recognize at the point that you did the conversion. So that's something I think to keep in mind. And I also wanted to make sure that you don't forget that the qualified charitable distribution is still available for those that are 70 and a half or older. Basically, this allows you where you can transfer from your IRA directly to a qualified charity that's limited to $100,000 per year for the individual. And the trustee can just transfer it directly to the qualified charity. When you do it this way, then the distribution doesn't count as taxable income for you. You also then are not allowed the charitable deduction from an itemized deduction standpoint, but it can count as towards your individual required minimum distribution. And where this really comes into play is there are certain things that are triggered by what your income is. And so by doing it this way, you basically, that prevents that distribution that you're going to contribute. It's not included in your income. So in some cases, you may actually end up getting some benefit elsewhere because that distribution that you intended to contribute to the charitable organization didn't gross up your income for you to then turn around and take an itemized deduction. So that was just something I wanted to make sure you were aware of. One thing that has been kind of talked about a little bit is there's a Form 1099-K reporting. It's been around for a while. Basically, it reports, payment card transactions like debit cards, credit cards. In 2022, prior to 2022, they were required to report if there were gross payments that were greater than $20,000 and there were more than 200 transactions. Well, beginning in 2022, this reporting requirement was set to require reporting if the transactions totaled over $600 and there was any number. So basically, if you had one transaction that was $601, they were required to report to the IRS this income, which, has kind of put the accounting profession, trying to figure out how they were going to deal with this, because the fear was that really income was going to get reported to the IRS that was not true business income. I've had taxpayers tell me that, like, for instance, one of their kids would be in college, and it would be fairly common for a group of them to go out to eat. Well, what they would do to save, I guess, having the hassle of having all of the bills split up between all of them, one person would pay, and then the others would just Venmo to them. Well, they said that it was kind of jokes, that you never knew what the other people were going to put the reason for the payment. I mean, some of them would put, for services, different things. So our fear was that items like that were going to get captured as if they were business income, but they really weren't. It was just somebody reimbursing somebody for something. And, once it gets reported to the IRS, then we have to make sure that it actually gets reported on the tax return. And so this was one of the things that we've kind of worried about all year. Well, December the 23rd, the IRS, I guess, finally realized that this was a bit of an issue. That's pretty extreme to lower the reporting threshold from payments greater than $20,000 down to payments greater than $600. and transactions greater than 200 down to basically just one transaction. And so they did make an announcement on December the 23rd that 2022 was going to be treated as a transition year. And basically organizations could continue to report using those higher thresholds. We're hoping that that's what happens, but I think everybody just needs to be aware that if they do receive a Form 1099-K for 2022 and forward, they need to make sure that that gets to their tax preparer so that it's appropriately reflected on their tax return, because we certainly don't want income getting reported to the IRS that's not reflected on the tax return, because then, you're going to start getting notices from the IRS when they do all the matching. So Josh, that was all I have. Does anybody have any questions?
Brenda, that was great. Thank you very much.
Uh-huh.
A lot of good information. I'm going to switch. So everybody can contact Brenda there, at byoung at sga-cpas.com. And then you can call them direct or on their cell. And if you need that information, we can also get that to you as well. I'm going to steal the screen back from you here.
Okay.
And put our information up here. So any questions that you'd like to talk to us about, you can give us a call at 817-210-3444. You can also email us at clientservice@stripmatterwealth.com. Also, we've got a great weekly market update e-newsletter. You can go to our website to sign up for that, and then be sure and tune in to our radio show on Saturdays at 10 a.m. on 1190 a.m., where we host your questions and answer your questions on a show called Ask the Experts. So that said, I'm going to stop the recording, and then we'll take some questions if anybody has any. Give me one moment here.